On to your markets news now. Asian markets were mixed at the close, with Hong Kong registering a decline. That's despite concerns around the potential for oil prices to surge higher levels not seen in many years, which would have inflationary impacts. The Nikkei share average rose by 0.9%. The Hang Seng Index declined by 1.1%, while the Shanghai Composite Index ended the session flattish, up 0.04%. US markets ended yesterday's session in negative territory on the back of the rising tensions in the Middle East, with crude oil prices registering their highest price settlement since January this year. The tech counters fell hard, with all of the Magnificent Seven declining, with Tesla the hardest hit. Uncertainty on a number of fronts is creating jitters, with some suggesting that the current high stock valuations on US markets may need to come down a bit to align with market fundamentals. The Dow Jones Industrial Average declined by 0.7%. The S&P 500 lost 0.84%, while the Nasdaq Composite Index closed 0.91% in the red. All right, looking at our local indicators, we see that the all-share index is currently down 0.9% at 94,370 index points. In terms of our currency, we see that the rand is trading at 18.09 against the US dollar, 20.82 vis-a-vis the euro, and 24.35 against the British pound. Some weakness there. Gold is trading at $3,377 an ounce, platinum at $1,282 an ounce, while Brent crude oil is trading at a whopping $76.16 a barrel. All right, let's get into the conversation with Chantal Marks. She's the head of equity research at F&B Wealth and Investments. And of course, a lot is happening right now. The main focus being what is happening in the Middle East. Major concerns around what this could mean, particularly for the oil price. Of course, there's the horrid consequences of conflict, people dying and so on and so forth. But just from a market's point of view, as we speak in terms of markets, concerns are around what will happen to the oil price, which could be inflationary. All right, let's get into it with Chantal Marks. She is the head of equity research at F&B Wealth and Investments. Thanks very much for joining us, Chantal. So the US Fed is making its call on interest rates today, and seemingly the US economy is not doing very well. Do you expect a rate cut today?
No, at this point in time, I think it's the uncertainty around the inflation outlook is still going to dominate the Federal Open Market Committee discussions. The best we can hope for today is the prospect of more cuts. I would think that they would continue to pause, particularly given rising geopolitical risks in the form of the situation between Israel and Iran, potentially having inflationary consequences because of higher oil prices. But they will give us a dot plot. They will give us their economic projections, and that should at least give us some idea of what the path ahead will look like.
Yeah, well, still sticking with that topic, I mean, the Middle Eastern tensions are growing by the day, and there is a concern that the United States is set to get directly involved. On top of that, there are concerns, of course, around the oil price, that it could blow out because it hasn't really reacted in the way that one would have thought. But of course, as things intensify in the Middle East, it could blow out. And if it does, what sort of levels do you think, we could conceivably see? And if we do, what are the economic consequences?
So I think the reason we haven't really seen a major blowout in the oil price is twofold. So firstly, the oil market is in a supply surplus at the moment, which means that oil-producing nations are producing more oil and putting more oil to market than what is currently being demanded. The second reason is that for now, it does seem as if the conflict is quite contained, and we haven't really seen an impact on supply routes. And I don't think for now the prospect is that this will become a broader conflict in the Middle East, drawing in very important oil-producing nations like Saudi Arabia and Iraq. So I think that's why we've seen a bit of a lift. Well, not a bit of a lift. It's been a sizable increase in the oil price, but it by no means is a blowout. I think if we do see the conflict broadening, or we do see supply routes severely disrupted, that could result in higher oil prices. And I think from a South African perspective, that's obviously quite negative. We are a net oil importer. This could have negative consequences for our terms of trade, our rand, inflation, and ultimately, if it becomes a real issue, interest rates as well.
Yeah, the thread running through our conversation today really is inflation. We got our local inflation print from Stats SA for the month of May, rising by 2.8%. That's pretty much the same as the month of April on a year-on-year basis. But with all the global macroeconomic parts that are moving currently, do you think that this could be short-lived? Could we see slightly higher inflation than was previously anticipated?
So I do think that the risks to the inflation profile are currently elevated. A combination of potential tariff impacts filtering through to South Africa's import basket, as well as our export basket. The impact of higher oil prices could have negative consequences for inflation. And then there's also the question of base impact. So we had seen inflation come lower quite meaningfully from the second half of last year. So that just means that the base is less demanding than it was for the first half of this year. So naturally, you could see an uptick in inflation going forward. For now, though, inflation does seem well contained at below the target range of 3 to 6%. But yeah, I think the next few months will be we could see some of the consequences coming through from both the tariff regime as well as from higher oil prices due to the geopolitical situation in the Middle East.
All right, Chantal, thank you so much for your time and insights and your patience there. That was Chantal Marks. She's the head of equity research at FNB Wealth and Investments.